Welcome to Module 1, Real Mortgage Credit Advocate Services versus Outdated Credit Repair Methods. I want to congratulate you on taking your first step in becoming a credit and mortgage advocate exert. This module is presented by Craig Rice, the chair of the Certification and Accreditation Committee at OCAM, in partnership with Four Corner Holdings, LLC. Both organizations are dedicated to raising the standards of mortgage credit advocacy, focusing on client empowerment and strategic long-term solutions. In this module, you'll explore the key differences between traditional credit repair and advanced credit advocacy techniques. You'll learn how to leverage ethical, effective, and compliant methods that truly prepare clients for mortgage approvals, setting you apart as a leading expert in the industry. Let's get started. In this module, we will cover several critical topics: the common pitfalls of outdated credit repair methods, the risks associated with aggressive dispute tactics, the importance of proactive, ethical, and strategic credit advocacy, a step-by-step approach to resolving credit issues tailored for mortgage clients, the significance of selecting the right clients and educating them as part of long-term success strategies. Each of these elements is crucial in distinguishing yourself as a knowledgeable and effective credit and mortgage advocate. As we proceed, keep in mind that your goal is to not only improve credit scores, but also prepare clients for successful mortgage outcomes. Let's start by addressing outdated credit repair methods, which are often ineffective and risky for clients. Automated dispute software. While these tools offer quick solutions, they can be dangerous. Many traditional credit repair companies use automated systems to blanket dispute every negative item. This approach lacks strategy, potentially leading to frivolous dispute flags and legal consequences. Automated disputes often ignore the financial context, risking unintended harm to the client's financial health. The shotgun approach. Another outdated method is disputing every negative item, regardless of legitimacy. This might produce initial results, but it isn't sustainable. It can backfire when creditors validate debts or when removing positive items disrupts a client's credit history. Limited engagement. These outdated approaches focus narrowly on disputes, ignoring long-term credit rehabilitation. While short-term results might be visible, they fail to foster lasting change, limiting clients' ability to secure mortgages. In contrast, ethical mortgage credit advocacy employs a more strategic approach, addressing credit issues that truly matter in mortgage approval. It's about finding sustainable solutions for the client's overall financial stability. Now, let's cover consequences of aggressive and improper dispute tactics. Using aggressive dispute tactics can have serious consequences, both legally and professionally. There could be legal repercussions. Over-disputing accounts or recent delinquencies may provoke creditors, leading to judgments, liens, or even legal actions. This can disqualify clients from certain loan programs like FHA, VA, or USDA, making it harder for them to secure mortgage financing. Damaged credibility with LOs and realtors. Realtors and loan officers depend on credit advocates to prepare clients for mortgage eligibility. Mismanaging disputes not only impacts the client, but also harms your reputation with these essential partners. Re-aging accounts. When disputing certain accounts, like medical debts, without understanding the potential impact, you risk unintentionally re-aging the debt. This makes the account appear more recent, negatively affecting the client's credit score. The key takeaway is that mortgage credit advocacy must prioritize the client's long-term financial success and mortgage readiness, not just short-term credit score improvements. As a mortgage credit advocate, your work begins with comprehensive credit analysis. This involves a detailed review of the client's credit report, focusing not only on improving scores, but also on addressing specific issues that impact mortgage underwriting. By analyzing all aspects of the report, you gain insights into the factors that may influence mortgage approval. Next, your approach involves ethical and strategic disputes. This means identifying legitimate inaccuracies that could affect the client's financial stability and addressing them in a manner that does not create additional financial strain. Your disputes are selective and targeted, designed to remove inaccurate information while ensuring the integrity of the report. This helps protect the client from unnecessary risk and ensures disputes are strong enough to hold up under lender scrutiny. Finally, your role is to develop tailored credit action plans. Instead of using a one-size-fits-all approach, you create a customized plan that aligns with the client's financial history and long-term mortgage goals. These plans focus on key areas that matter most in mortgage decisions, such as reducing debt-to-income, DTI ratios, optimizing credit mix, and building positive trade lines. By taking this strategic and personalized approach, you prepare clients for successful mortgage outcomes, helping them achieve not just better scores, but true mortgage readiness. When it comes to choosing what to dispute, not all negative items on a credit report should be addressed. For example, collections, charge-offs, and even paid-off loans that have a positive payment history require careful consideration. Removing these items might reduce the client's credit score, even if the removal is successful. It's important to focus on disputes that can genuinely improve the client's mortgage eligibility while minimizing unintended score drops. In contrast, there are cases when not to dispute certain items. For instance, charge-offs that are more than 2 years old, or loans with a history of positive payments, may be best left intact. Lenders, particularly for FHA, VA, and USDA loans, often overlook older charge-offs. These items may have little impact on approval, and disputing them could divert attention from more critical areas. Understanding debt prioritization is also essential. High-dollar medical debt, for example, may not always be the first target for dispute, especially since many lenders overlook medical collections below a certain threshold. Instead, focusing on debts that affect the client's debt-to-income ratio or overall credit utilization may have a more meaningful impact on mortgage approval. Tailoring your dispute strategy to align with the client's broader mortgage goals ensures a more efficient and effective approach. Strategic disputes are about more than removing negatives. They're about improving the client's credit in a way that supports successful underwriting outcomes. Now let's cover managing collections for mortgage readiness. Let's focus on 3 critical strategies that can impact a client's ability to qualify for a mortgage. First, let's discuss pay-for-deletion agreements. Before advising a client to pay off a collection, ensure the creditor agrees to remove the account from their credit report entirely. Why is this important? Simply paying the collection may not improve the client's credit score, especially if the negative entry remains on the report. A successful pay-for-deletion request can help prevent further score damage and improve the client's overall mortgage readiness. Next, it's crucial to avoid score drops. When collections are paid but not removed from the report, it can reset the date of last activity, or DLA. This reset can actually cause a credit score drop, potentially complicating the mortgage approval process. Therefore, always confirm deletion upon payment to prevent this setback. Lastly, when handling non-medical collections over $2,000, it's crucial to manage how these debts impact the client's debt-to-income, DTI ratio. For clients with over $2,000 in combined non-medical collections, FHA guidelines require lenders to factor 5% of the total balance of these collections into the client's DTI ratio. This means that while deletion of these collections can be beneficial for improving credit scores, it is not strictly required for FHA qualification. Instead, ensuring the client's DTI remains within acceptable limits is key to improving their mortgage readiness. By carefully managing these aspects, you can significantly improve a client's chances of securing a mortgage. Remember, proactive credit repair strategies are key to navigating complex underwriting requirements. Now let's focus on the importance of building positive trade lines for mortgage approval. While many credit repair efforts center on removing negative items, it's equally vital to add positive accounts to a client's credit profile. Positive trade lines, such as credit cards and installment loans, play a crucial role in boosting creditworthiness, which is often necessary to meet underwriting requirements. Let's start with low credit utilization. For revolving accounts, maintaining credit utilization below 30% is critical. This strategy not only improves a client's credit score, but also signals to lenders that they can effectively manage their revolving debt. High credit utilization, on the other hand, indicates financial stress, which can be a red flag during the underwriting process. Now let's talk about installment loans. Encouraging clients to add installment accounts, like a self-lender account or personal loans, is an effective way to enhance their credit mix. A balanced mix of credit types helps build a stable credit profile, which is essential for mortgage underwriting. This approach demonstrates the borrower's ability to manage different types of credit responsibly, increasing their overall chances of approval. In summary, building positive trade lines through low credit utilization and strategic use of installment loans not only boosts credit scores, but also creates a stronger, more reliable credit profile for clients looking to secure a mortgage. In this module, we'll explore strategies for avoiding counterproductive payments when dealing with charged-off accounts in credit repair. First, let's discuss when not to pay charged-off accounts. In some cases, paying a charged-off account might not improve the client's credit score and could even refresh the date of last activity, or DLA, potentially harming their credit profile. Therefore, it's essential to evaluate whether making a payment will truly benefit the client's credit score or mortgage readiness before proceeding. If there is no clear benefit, paying these accounts should be avoided to prevent unintended setbacks. Now, let's consider alternative solutions for problematic accounts. Sometimes, accounts that are in collections or have been charged off can be left unresolved if they pose minimal risk to the client's mortgage goals. In such cases, it's more strategic to focus efforts on high-risk accounts that actively hinder the client's ability to secure a loan. By prioritizing accounts that significantly impact credit scoring or mortgage approval, clients can effectively improve their overall credit standing without unnecessary financial strain. By understanding when payments can be counterproductive and identifying which accounts to address first, you can better guide clients toward successful credit repair and mortgage approval. In this segment, we will discuss client selection and education, two key components of successful mortgage credit advocacy. First, let's focus on choosing the right clients. Not every client may be ready for mortgage credit advocacy. It's important to perform a thorough assessment to identify those who can genuinely benefit from your services. This involves evaluating their current financial situation and credit profile. For clients with severe credit challenges that may be more suitable for bankruptcy or debt settlement, it's essential to make the right referrals. By directing clients to appropriate solutions, you maintain credibility and ensure better outcomes for all parties involved. Next, let's talk about client education for long-term success. Once a client's credit profile has been improved, it's equally crucial to educate them on maintaining this progress. Teach clients how to avoid damaging their credit, such as keeping their credit balances low, making timely payments, and avoiding unnecessary inquiries. Emphasize the importance of adopting healthy financial behaviors to sustain their improved credit status, as this can significantly impact their ability to secure and maintain a mortgage. Remember, success in credit advocacy is not just about immediate credit repair. It's about equipping clients with the tools and knowledge for lasting financial stability and mortgage readiness. In this module, we will explore the long-term benefits of mortgage credit advocacy, highlighting two critical outcomes: better client results and stronger professional relationships. Let's begin with better client outcomes. Effective mortgage credit advocacy leads to improved credit scores, increased financial stability, and higher chances of mortgage approval for your clients. By guiding them through credit repair, score optimization, and education on maintaining healthy credit habits, you help clients not only qualify for a mortgage, but also secure better interest rates. This can translate to long-term financial wellness as clients become more knowledgeable and proactive about managing their credit. Now, let's discuss stronger relationships with loan officers, LOs, and realtors. Consistent success in credit advocacy can position you as a reliable resource within the real estate industry. Loan officers and realtors highly value professionals who can help convert potential leads into qualified buyers. By providing dependable credit solutions, you foster trust and collaboration, leading to more referrals and sustained business growth. Strong partnerships with LOs and realtors not only boost your credibility, but also create a steady stream of clients, enhancing your reputation as a mortgage credit expert. In summary, mortgage credit advocacy is not just about immediate credit repair. It builds a foundation for long-term success, benefiting clients and strengthening your professional network. As we wrap up this training module, let's summarize the key points we've covered. Real mortgage credit advocacy goes far beyond simply disputing negative items on a credit report. It's about developing a comprehensive strategy that aligns with your client's mortgage goals, ultimately positioning them for long-term success. The skills and strategies you've learned here empower you not only to help clients improve their credit, but also to guide them towards sustainable financial habits. This ensures their readiness for mortgage approval and better financial outcomes. Remember, you're not just repairing credit, you're building the foundation for your client's future financial well-being, all while strengthening your professional relationships. This approach not only benefits your clients, but also establishes you as a trusted partner for loan officers and realtors. Thank you for dedicating your time to this module. You are now better equipped to understand the true essence of real mortgage credit advocacy compared to outdated credit repair tactics. This training has been brought to you by ACAM, a leader in setting high standards for compliance and mortgage credit excellence in collaboration with Four Corner Holdings. Think of ACAM as your toolbox for ongoing success, providing you with the resources, templates, and compliance support needed to excel in this industry. Thank you once again for your commitment to professional growth and for choosing to make a real impact in your clients' lives.